Hello and welcome to this Business Today Market Special. I'm Udayan Mukherjee. With me is Aabha Bakaya, and our guest for today is one of the most respected financial analysts, bank and insurance stock analysts in the country, Suresh Ganapathy of Macquarie. Because there's so much buzz around the LIC listing and what is going to happen with bank stocks with these interest rate hikes that we thought we'd get a focused analyst to talk about how to treat this universe. Suresh, great to have you on the show.
When we're looking at the basket, if there's a particular strategy you'd see the financial pie with at the moment, because on one hand, there's been a resumption, of course, in interest when it comes to the retail loan book, to the kind of profitability with the changing rate scenario as well. Is there a particular part or segment of the financial pie that you think will benefit going forward?
Well, on the contrary, I feel more than the benefit, I think the bigger issue could be on the corporate loans, because some of the capex related loans which we thought would come back because rates were relatively okay, and at the margin some incremental capacities could gather steam. Unfortunately, that takes a backseat because of the current environment, both on the macroeconomic front and also what is exactly happening with respect to the wage cycle. As well as the growth drivers are concerned, I think a couple of years, during the COVID period, clearly banks had to shy away from unsecured credit. We have clearly seen the risk appetite for the banking system also picking up, and also at the consumer or the demand level, you are seeing rise and pickup for unsecured loans. So I think within the broader risk parameters that banks cater to, largely selling to internal customers, and also you've all seen a good pickup in mortgages over the course of last couple of years. I think retail will continue to be the support system for the banking system when it comes to growth. And within that, you'll definitely see, even though there are it's a rising interest rate environment, I do believe that on the supply side, banks will be a bit more active trying to do some of this unsecured loan business, and therefore that is also going to be a good growth driver over the course of next couple of years.
How do you map HDFC and HDFC Bank stocks from here on, Suresh? Because after the initial enthusiasm on the first day, it's been one way, which is down basically. But do you think all the bad news about the regulatory costs, etc., is in the price now? Or would you be circumspect even going forward from here on those two names?
Well, Udayan, we still need to have clarity from the Reserve Bank of India about the shape and size and structure of the deal, right? So the problem here is that in case let's hypothetically assume the regulator insists on a holding company structure for the deal, then it's going to be very negative for both HDFC Limited and HDFC Bank shareholders, because the cost of the merger goes up, right? I mean, there's a tax issue with respect to setting up an holding company structure and transferring stakes. Separate legal entities have to be set up. The cost of compliance goes up. There is a delay with respect to the merger. So and of course you need to really work on the share swap ratio. I don't think the current share swap ratio can justify an holding company structure. So those are some of the regulatory uncertainties which exist, and also we need to really see whether the regulator gives them a grandfathering period, right, when it comes to priority sector loans, or for that matter any of the statutory requirements. Till the time the clarity emerges from the regulator on some of these finer aspects, the underperformance will continue. So let me be honest, it's going to be difficult for investors to make money in this stock from very near-term perspective till some of these uncertainties are over and gets removed. But if I were to look beyond that, I think the valuation at which your HDFC Bank is available today, and also the kind of stability that the mortgage book brings, and the corresponding opportunities which is available for HDFC Bank. Remember, every bank in the country which has done very well in the last couple of years, the large bank, they all have done through mortgages, right? And this was a big lacuna in the portfolio of HDFC Bank. So 3-4 year perspective, I'm very, very bullish on the stock, but near term, till the regulatory uncertainty gets removed, the stock is not going anywhere.
So what has happened over the last few quarters, Suresh, as you would have noticed, is that ICICI Bank's discount to HDFC Bank has vanished, has closed out completely. But do you see that relative outperformance of ICICI over HDFC continuing, even growing stronger in the quarters to come?
Till the time this uncertainty persists, I think Udayan, you will see this trade playing out because look, I think we are one of the few bankers who are not there on this deal with HDFC Bank, right? So we had the opportunity to have a very frank conversation with closer to 100 odd investors over the course of last 1 month across the globe, whether it is Asia, US, Europe, and also for that matter the domestic mutual funds and insurance companies. And the unanimous pushback or the trade that a lot of people are playing out is that we just don't want to enter into a stock where there is so much of uncertainty and so much of news flow surrounding the stock, right? Like what is RBI going to do? What's MSCI going to do? And all those kind of uncertainties. So if you have a cleaner, plain vanilla play in the system and a suitable, credible alternative to HDFC Bank, which wasn't the case earlier, right? I mean, ICICI obviously had its own set of issues, but today we have a cleaner and a much more stable ICICI. We just don't want to touch HDFC Bank and we want to go and play the broader macroeconomic triggers, or be it rising margins or whatever you're talking about in terms of the overall economic parameters driving the stocks. ICICI is a far better way to play the banking system than HDFC Bank. So I think that particular trade will continue till the time there is clarity emerging with respect to this deal. So though the discount of course has narrowed, I do believe that in the interim, ICICI Bank still has the stock has still more legs to rally. Yeah.
Suresh, we'll come back to some more of those banking names, but talking about Paytm, and do you still do you find value at these levels? Do you still find it expensive, given that we're also expecting MobiKwik to come with its IPO sometime this year? In fact, they're just waiting for market conditions to improve, so further competition in that space.
How do you really decide what is expensive for some of these fintech names with not much cash flow and earnings, right? So, I mean, there is no concept of price to earnings or price to cash flow metrics for any of them. So, we are looking at price to sales, and we have seen how some of the tech stocks in the US have corrected rapidly, right? So, the beauty of public markets is that a price to sales metric which looks 10 times cheap, 10 times they may look cheap, at 4 times also it looks cheap, and 3 times also it looks cheap, and these stocks can very well go down from 10 times to 3 times, right? And that's what has actually happened with a lot of these tech names. So I guess it's very, very difficult to argue for a bottom fishing in some of these names, and I'll still be a bit more guarded here, because unless and until I see a very credible path towards profitability in some of these names, I'll be a bit more skeptical. And particularly coming to Paytm, or for that matter, any of these fintechs in India, my concern has been that unless and until you end up getting a manufacturing license, which is basically ability to underwrite loans or underwrite insurance on your balance sheet. But I've also seen the news release that the deal with Raija QBE has fallen off because there has been no regulatory update. So perhaps the regulator has not given them the approval, and of course the timeline has elapsed and the deal has fallen off the table. Very clearly gives some kind of an indication that there is reluctance by the regulators to actually give possibly licenses for manufacturing. So if you're just going to be a mere distributor of products, then there is only up to a certain scale and size that you can grow, beyond which to achieve scale with profitability remains a challenge. And that's been my biggest concern across these names.
When the HDFC Bank deal happened, Suresh, a lot of commentators, including bankers, made the point that maybe the arbitrage which NBFCs enjoyed over banks has shrunk to such a point that it does not make any sense any longer to remain as an NBFC. And therefore, this rush that maybe a lot of these companies should become banks. Where do you see a Bajaj Finance in the light of that observation?
Yeah, look, I think, we don't cover Bajaj Finance, but I can just generally give you a different perspective on this matter. Look, I think we have always been of the view that banking is size agnostic, but being an NBFC is not size agnostic, right? So what it means is that at some critical threshold size level, it starts biting you. I mean, because to grow profitably becomes a big challenge, considering the fact that you cannot accept the low cost retail deposits, right? And as you grow bigger and larger, it becomes very difficult to compete in very, very commoditized segments. For example, housing finance, where obviously the banks are going to really offer you the best possible rates. For that matter, even unsecured loans, right? A good quality customer with a good credit score is always going to a bank, because the bank is going to outprice you. So I guess if you're small, you're fine be operating as an NBFC in those niche markets. But once you become large, I think clearly the regulatory arbitrage is ending. If you look at in every aspect, Reserve Bank of India, be it in terms of harmonizing the accounting norms, NPL recognition norms, capital norms, liquidity coverage norms, LCR norms are not even existing for them. All of them have been brought in line with a banking system, making life very difficult for NBFCs to grow, to become large and also become profitable at the same time. I think the eventual end game is to get a banking license in some form or shape. The critical call here is what is the law of the land at that point in time. So I'm not sure whether the Reserve Bank of India is happy giving licenses to corporate houses to get a banking license. So the way this would play out is that a large NBFCs who don't have, who may have a corporate backing or who may not have a corporate house backing, eventually will have to fold up into some other bank, right? So while an XYZ NBFC may not be given a banking license, but if that NBFC is willing to get merged into a bank, you effectively end up getting a banking license. That's how it's the game. And that's what has happened with HDFC Limited, right? It's the limited, which is the parent entity, which is reverse merged into the bank. And RBI is fine with that structure.
We were talking about LIC earlier, Suresh, but if you look at even the private insurance companies, they've been such a disappointment because even a couple of years back, everybody was very bullish on this space, but they've just not delivered. What are the key reasons for this underperformance, and do you see this space continuing to disappoint?
Actually, I'm very positive on some of these private life insurance names. You take any sector, Udayan, right? I mean, across various industries, even in financial services itself, you look at it in terms of banks, you look at it in terms of other subsectors and stuff. It's always the privates which have gained market share over the course of last several years. And even this year is a testimony to the same thing. LIC actually has lost market share in the individual AP segment, right? The retail premium, despite, of course, trying to list during this period. If you look at, of course, these are all public numbers. FY22 LIC's market share has further dipped down from 40% to 37% in the individual premium segment that I'm talking about, AP segment, right? Whereas private sector has gained market share.
Pick one stock or your top three right now when it comes to the financial basket, and I'm not asking you to give a recommendation, but I'm trying to get get from you something that you are just amazed with in terms of traction, the story, the kind of turnaround they've seen, any story that you like that you can share with us, the top 1, 2, 3 names right now.
Yeah. So, I'm still sticking with the large conventional ones because it's like I do believe that the FANG model will work everywhere. I mean, in the sense that the large ones are going to become larger and bigger and they will dominate. And it makes more sense to stick with the larger ones over a longer term time period. So, obviously, near term concerns are there for HDFC Bank, for that matter, for the entire sector because of a rising rate cycle. But I still believe that HDFC Bank and ICICI Bank are going to be the eventual winners if you were to really look at from a 5 to 10 year perspective. So these should be core holdings in my view. But I think beyond that, if I were to really look at a bit more favorably towards some of the cheaper names, cheaper valuation names, I believe that it's SBI and IndusInd Bank. I guess SBI has done exceptionally well this year fundamentally. So I'm very surprised to see the kind of underperformance, but that's there across the financials. So SBI clearly stands out to me in my opinion. And also IndusInd Bank, they've done pretty well. They're also emerging out of a bad cycle when it comes to the corporate asset quality cycle, or for that matter, the MFI and the commercial vehicle space. I think cyclically you're also in a good position, and they also run a very high operating profit model. So yeah, these are the two picks beyond HDFC and ICICI where I will clearly be bullish over the course of next 12 to 24 months.
If you like the video, do like, comment, share and subscribe.